Hey Doc, Sean Duncan with SMD Consulting and Accounting. Today, the C Corp. Let's talk about this. This thing has a lot of mystery around it. First, disclaimer time. All right, disclaimers all over with. Let's get to it. C corporations. C corporations, when you form them, might as well be you having a kid. They have their own tax, their own life. They can exist after you're done. They're a very specific entity type that is designed to create a meaningful separation from you and the entity itself. Now, the other entity types we've talked about, sole proprietorships, S Corps, partnerships, they all have a flow through. When the company earns money, it flows through and hits your personal tax return. C corporation doesn't do that. This new child you had, it pays its own taxes. How do you get money? Wait, it pays its own taxes. Does that mean it keeps the money? Yes. It keeps the money until it chooses. Now, again, you might be in control of this thing, but until it chooses how you're going to get it. See, you can only get the money from the C corporation as a wage, as a dividend, through dissolution and shutting the whole dang thing down. And technically you can do it as a loan, but you got to be really careful because a lot of people try to game that. And I'm not talking about gaming the system. It's really taxable events like a wage, a dissolution, or a dividend. So if you just paid attention, I just said the C Corp pays its own taxes. And then when you receive money, you're going to pay taxes. This is the concept of double taxation. Now, a lot of people go, no, Sean, I've already figured this out. See, what my CPA has me do is at the end of the year, I send myself a paycheck for exactly the net income. Ha ha ha, I've beat the system. I'm paying no tax at the corporate level. Well, let's do a little bit of math real quick here. When you pay yourself a wage, you're going to pay it as an ordinary income tax rate, right? Maybe you're in the 37% bracket. You're going to possibly have state income tax implications, and wages are subject to employment taxes like Social Security, Medicare, and unemployment in your state, and even the federal unemployment, believe it or not. So that's multiple taxes just to get your money home. But if you had just left the money in the C Corp, it would pay a 21% rate. Now, that doesn't automatically mean that's all you do. What I want you to understand is there's math involved here. I just told you 37% plus possibly 15% plus your unemployment tax compared to 21. But Sean, the money's still trapped in the company if I do that. Yeah, that's the thing. There are multiple ways to get the money out of the company, and saving 1, 2, 5, 15 percentage points, that's real money. Understanding these rules is what drives this machine. So the C corporation has this huge advantage in the world of law that it truly has a lot of separation of liability. Because it is its own creature, it's its own child, we get that liability protection. Lawyers love the C Corp because of that. It's very clean, clear rules. Now, there are piercing the veil rules where you can screw everything up and commingle it. We're not talking about that. We'll cover that stuff later. But what I want you to understand is the liability protection's phenomenal. It's this tax implication thing. In general, and this is not for everyone, but in general, if you actually want the money to come home so you can enjoy it and pay for your student loans and pay for your kids' college and take a vacation, I don't want you to get double taxed. But the C corporation does have its place. It actually has some really cool extra benefits where it can pay for more medical costs. It can be for secondary investments. Did you have a surgery center that's separate from your medical practice? Maybe the surgery center stays as a C Corp. There's a lot of ways to layer these entity types. But when you're thinking about C corporations, I just want you to remember two very clean rules. One, it has the best personal liability protection for business concerns. Malpractice, we've already talked about this before. That's a different thing. But for business obligations, it has the best personal liability protection. It's phenomenal. Second, though, there's double taxation. You either pay two taxes from a wage, you pay the tax at the corporate level and then a second tax when the dividend comes out, or you pay the tax when it's earned and then you pay a tax when it's dissolved. We got to manage that, man. I don't want you paying more money in your taxes. So keep in mind that C Corps do have their place, and they have some really cool fringe benefit things that go with it as well. But I want you to be clear on the high level considerations. And so as we start talking about all these entity types and some more rules, I want you to remember that. We can see we're focusing a little bit on the high level stuff of liability and tax. There's a lot of nuance beyond that. Please consult your professionals to help you out with making the right choices. This is Sean Duncan with SMD Consulting and Accounting. Hey, Doc, hopefully I'm helping you out here.